Hi again, everyone, and welcome back to our next session, State and Local Tax Trip Around the United States. During this session, we'll take a drive through the United States to examine some of the most important state and local tax developments from the past year. We'll review significant SALT law changes, court case decisions, and other policy guidance that's impacting many businesses. Note these are not all the guidances available. If you're looking for weekly state and local updates, please sign up for Withum's Dash SALT. At the end of the slide deck, there will be a link to sign up for that subscription. Now, I'm Jim Bartek, partner and state and local tax practice leader located in New Jersey. We have a lot of presenters on this session, so let me quickly introduce them so we can get started. Becky Stidham is a partner in our San Francisco office. Becky has over 15 years experience working with all aspects of state and local tax and joined Withum over 3 years ago. Jonathan Weinberg is a principal joining us from Las Vegas and has over 20 years experience helping clients with state and local tax and has been with us for 4 years. Bonnie Susmano, senior manager, formerly of our New York office, now out of Atlanta. Bonnie has a tremendous amount of experience dealing with all issues related to sales tax. She's been with us for 5 years now. Penny Sweeting is a senior manager out of our Portland office, and she assists many clients with income, franchise, gross receipts type taxes in many states. She's been with us for almost a year now. Katie Nguyen is a manager out of Virginia who specializes in income franchise tax here at Withum. She's been at Withum over 2 years now. And Courtney Easterday is senior manager out of New Jersey. Courtney works with hundreds of clients in all industries to assist with sales tax issues and heads up our sales use tax compliance team. She's been with us for over 5 years now. Now, all of our presenters have significant experience in state and local tax. Now, next slide, please. Next slide, please. Yeah, and one more. Now, we're going to start out in the Northeast where Katie and Bonnie will talk about the updates there, and then we'll move to the Central where Penny and Courtney will discuss that. Then South, which is Jonathan and Bonnie, and we'll end up in the West with Becky and Courtney. Now, please remember to enter questions, and we'll attempt to answer them during the seminar. If we don't get to those questions during the seminar, we'll reach out after the session via email. Now, let's start with the Northeast, and I'll hand it over to Bonnie.
Hello, everyone. This is Bonnie Susmano, and I'm going to discuss Maine right now. Maine made some changes to its rules regarding the taxation of rental tangible personal property to make it consistent with the predominant method used in other states regarding the rental industry sales tax charges. Starting January 1st, 2025, sales tax is imposed on individual lease payments of tangible personal property, which will be imposed on the lessee. As it stands now in the state, the lessor pays sales tax up front on the full value of the purchase price of the leased or rented property. It should be noted, though, that the change in the law does not apply to leases in lieu of purchases, agreements that transfer control of tangible personal property under a security agreement, agreements for the rental of tangible personal property with an operator that's necessary to perform the right actions of the property being rented, and the lease or rental of video and media equipment, which are all subject to service provider tax.
So I'm Katie Nguyen. I'll be talking about the income tax topics in the Northeast. So first up is Massachusetts. So a couple months ago in July, Massachusetts published an administrative release stating that corporations and financial institutions would be subject to a single sales factor apportionment formula beginning in tax year 2025. And the state has required companies to use a 3-factor apportionment formula with double-weighted sales for years, but will be requiring this change for corporations and financial institutions effective in 2025. So this could be a benefit for companies that have a heavy physical presence in the state with sales all over the country without having to consider the property and payroll factors. The overall apportionment could be diluted. However, this could also increase apportionment for companies with no physical presence without having the ability to dilute that factor with no property and payroll sales. So only considering the sales factor could increase apportionment overall, even if the activity remains the same year over year. So this should be noted for planning purposes for estimated payments and additional planning purposes as well.
Okay, Massachusetts adopted a regulation for advance payments of sales and use tax. On April 12th of this year, the Mass Department of Revenue adopted a regulation for the advance payments of sales and use tax, which outlined various procedures for the advanced payment to be reported. And it also expanded taxpayer protection from the imposition of underpayment penalties. The advance payment required is the lesser of either one, the tax collected on or before the 21st day of the filing period, or two, 80% or more of the taxpayer's total tax or excise due for the immediately preceding month, provided that there was such a liability in the prior month. But this rule does apply to certain types of taxpayers and tax types. So it's important to read the entire regulation, but for sales tax purposes, the taxes collected is equal to such taxpayers' gross receipts from taxable sales multiplied by the applicable tax rate. A marketplace facilitator must include gross receipts from taxable sales made by the facilitator itself and made by the facilitator on behalf of third-party marketplace sellers. Tax collected does not include use tax that the taxpayer owes on its purchases. Next. Well, the good news is Massachusetts announced an amnesty that began on November 1st. The amnesty runs from November 1st through December 30th, 2024. Mass is going to waive most penalties for eligible taxpayers who file outstanding returns and pay the tax and interest due with their returns by December 30th of this year. When the department says eligible, they're including taxpayers who file personal income tax, corporate excise taxpayers, trusts, estates, or sales use tax. It's important to note, though, that taxpayers must have submitted an amnesty request by November 1st. So hopefully anybody that needed to filed it by November 1st. Also important to note, non-filers may be eligible for a 3-year look-back period if the amnesty request was submitted for all filing periods with the due date on or before December 31st, 2024. But the really good news is that eligible taxpayers will not be required to establish reasonable cause for the failure to file or properly report the underlying Massachusetts tax liability. Plus, the program allows eligible taxpayers presently under audit to seek amnesty as to the amounts at issue in such audit. Plus, the amnesty program expressly permits eligible taxpayers who filed returns which underreported the Massachusetts taxes due to file amended returns and pay the resulting tax in exchange for a penalty waiver, which is clearly a provision designed to encourage the voluntary disclosure of known outstanding taxes. So this is a great thing all around. Next. And the news gets even better because Massachusetts put in place a 60-day amnesty program in 2025 as well. It enacted legislation to allow the department to put in place another amnesty. So there's going to be a 60-day tax amnesty in 2025. And if a taxpayer fails to pay the full liability that's owed by June 30th, 2025, which is the expiration date of that amnesty in 2025, the commissioner shall retain any payments made and apply the payments against the outstanding liability, and the tax amnesty will not be applied to that respective taxpayer. So something to keep in mind.
So in June, New Jersey lawmakers passed a law to increase the corporate tax rate. So this the state is assessing an additional 2.5% on tax with companies more than 10 million in New Jersey taxable income. And the new surtax will be effective for tax years beginning in 2024 and will go through at least 2028. And the state expects to raise around $1 billion in tax revenue, which will ultimately benefit the state's public transportation. So for companies with a large presence in New Jersey with over 10 million in taxable income for New Jersey purposes, this could be this should be accounted for in planning and estimated payments. Otherwise, if the payments are under the ultimate liability for the tax return, then penalties and interest could be assessed if the payments are under.
Okay, there's been a lot going on in New Jersey with respect to sales tax. So the New Jersey Senate passed a bill regarding the imposition of sales tax on the production and sale of intoxicating hemp products. Basically, there is now a requirement that any sale of intoxicating hemp products, like a beverage, by a holder of a plenary retail distribution or liquor license or wholesale license will be subject to sales tax imposed on cannabis and the optional local cannabis transfer and use tax imposed on cannabis by a municipality. In addition, the governor signed into law certain exemptions for the purchases of metal bullion and coins from tax. So interestingly enough, that was immediately enacted, and basically there's an exemption from sales and use tax on the sales of investment metal bullion and coins. The law amended the definition of coins to include only those coins having a fair market value of over $1,000. So note that this includes gold, silver, palladium, but it does not include jewelry. New Jersey is also providing a tax credit to artificial intelligence businesses. Again, New Jersey Senate bill was signed into law on July 25th, 24, and it revises various provisions under New Jersey's Economic Recovery Act of 2020, creating the next New Jersey program, and offers tax credits to artificial intelligence businesses that plan significant capital investments and job creation in the state. The reason the next New Jersey program was enacted is to attract new investments into New Jersey for artificial intelligence, jobs, and creation of other economic opportunities in New Jersey. Also, there's been some interesting news with respect to zero emission vehicles. The zero emission vehicles, there's been a lot of questions from taxpayers. So New Jersey responded to taxpayer questions and stated that purchasers must pay New Jersey sales tax when charging their zero electric vehicle car at a charging station. It's considered a taxable maintenance or service to tangible personal property and therefore taxable. And it's something to note because a lot of questions have been arising from this topic. Next. In addition, now we're moving on to New York. New York SaaS providers basically have automated customer employment management systems found to be a taxable license of software. In this particular case, a taxpayer provided automated systems for fulfilling and monitoring customers who had needs for temporary employees. And they did so through a web-based application delivered through a software as a service model. The New York Tax Appeals Tribunal confirmed an administrative law judge ruling that the taxpayer's charge for its vendor management system constituted taxable licensing of pre-written software that was part of a bundled transaction. The tribunal determined that the software and license were packaged with the taxpayer services and sold as one integrated service. Therefore, when if you don't know, if you bundle things that are taxable and non-taxable, it taints the entire amount to be taxable. So in this instance, the customer's contracts demonstrated that the software technology was the primary element of those contracts, and that customers were not just purchasing the taxpayer services, rather they were purchasing pre-written software to source, hire, and manage their contract labor needs. So the tribunal explained that to find otherwise given these facts would effectively create an exemption for certain sales of tangible personal property where none exists in the law. So in essence, you can't break it apart, and the whole service was found to be taxable. In the New York Appellate Court, certain taxable information services were found not to fall under a statutory exclusion. In this case, taxpayers provided services including the measuring of advertising effectiveness and disseminating related improvement recommendations. These constituted taxable information services that effectively are substantially incorporated into reports furnished to others, and thus could not be excluded from tax as personal or individual in nature. In doing so, the court explained that while the taxpayer insists that these are non-taxable consulting services, the record supports the finding that the primary function of the services is the collection and analysis of information. In addition, the court rationalized for its determination that the information from the taxpayers' provided reports can be regarded as substantially incorporated into reports furnished to others and into another database that's used for other reports, that it would furnish qualitatively valuable information and for its analysis services. So it's really important to note here that New York really does look at the primary purpose of what's being purchased.
So in March of this year, New York City released a finance memo that would increase the economic thresholds for income tax purposes effective for the 2024 tax year and going forward. So in prior years, the economic threshold was at 1 million in New York City sales, but it has since been updated to 1.128 million in sales to the city. So, and additionally, if a corporation is a unitary filer, affiliates must be included in the group return if an affiliate has at least $11,000 in New York City sales, which was previously set at $10,000. So, and then these thresholds are the increase is due to inflation. Next slide. So on to Pennsylvania, still income tax. So Pennsylvania had a few updates this year. Back in January, the state released a bulletin which provided guidance related to sourcing of sales of tangible and intangibles. The state applies a throw-out rule, which means that if receipts from intangibles, including goodwill, are not specifically described in the statute, these sales would be excluded from the numerator and denominator of the sales factor. So we can sometimes dilute the apportionment percentage by including this kind of sale in the denominator but not the numerator, which results in a lower apportionment percentage. However, because of this throw-out rule, this could result in higher tax than expected since the sales of intangibles are likely included in the taxable income base. So back in July, the governor also signed SB 654, which doubles the NOL limitation to 80%, which was previously set at 40%. And that basically meant you could only take 40% of an NOL, you could only utilize an NOL up to 40% of the current year's taxable income. But starting in 2026, this limitation will increase by 10%, so 50% in 2026 and so forward. So by 2029, it will be at 80%, and similar to other states as well. And additionally, the Senate also passed a bill this year to decrease the personal income tax rate from 3.07% to 2.8%. And this decrease to the tax rate is effective as of 2025 and should be included in planning purposes for individuals.
Okay, in Pennsylvania, the Board of Finance and Revenue reviewed an appeal of Allied Mechanical and Electrical, a construction contractor, where it was determined that the company was entitled to a refund of sales tax erroneously paid on purchases of building machinery and equipment, which was transferred to an exempt entity according to contract. The issue with this case was the fact that originally this company did not provide evidence of proof of payment for the contested transactions. And once they did so on appeal, the Board of Finance and Revenue approved a refund of tax paid on purchases of transformers, panels and parts, circuit breakers, luminaires, dimming system equipment, plumbing, fixtures with devices, emergency power control, wiring, lamps, because the company sufficiently provided the proper documentation and showed that the property fell within the definition of building machinery and equipment. The refund was approved, but not for flush valves because the board determined that it did not fall within the definition of building machinery. Okay, moving on to Vermont. Vermont enacted House Bill 887, repealing the sales tax exemption for pre-written software accessed remotely, and imposed a 3% surcharge on short-term rentals. The effective date is July 1st for pre-written software accessed remotely, and the effective date of August 1st for the surcharge on short-term rentals. This repeal was led to because they were trying to raise money for public school systems in Vermont. Next.
Thank you. Hi, my name is Penny Sweeting, and we're going to take a trip through the central USA. We're going to start with Colorado. Colorado reduced the rate in 2024 for income taxes. The Colorado Senate enacted a Senate bill created a system where certain revenue receipt triggers, if certain revenue receipt triggers are met by the state, the tax rate for all taxes, individual and corporate income tax, will be adjusted according to the revenues received. The rates going forward will depend each year. So for 2024, the tax rate will be reduced from 4.4 to 4.25. Next slide. Next, we'll go to Iowa. There's the continuing trend of reducing tax rates. The corporate rate was reduced 5.5 for income below 100,000 and 7.1 on income above 100,000. And that simplifies the progressive taxes to just the two rates. The individual rates will have a top margin of 5.7, and that will go down each year until it gets to 3.9 in 2026. And next slide. And in Illinois, they updated the qualified investment partnership rules. And just a refresher on the qualified investment partnership, EQIP is not to be confused with qualified improvement property, which is a federal term related to fixed asset. But EQIP is an investment partnership where at least 90% of the assets are from investments and 90% of the income is interest, dividends, or the sale, gain or loss from the sale of qualified securities. With the increase in private equity and partnerships as a mode of large-scale investing, Illinois is one of the first to update the definition of securities that are held in a qualified investment partnership to be expanded to include partnership interest. Traditionally, most states define EQIP as holding stock in corporations. The EQIP is required to withhold income tax at the Illinois rate of 4.95% on behalf of its partners, but the entity level replacement tax of 1.5% is no longer required.
Thanks, Penny. My name is Courtney. I'm going to speak a little bit about central sales tax items and updates that have happened recently. A big one that we're seeing is Illinois. Illinois has changed the remote seller tax rules to make sure that out-of-state retailers are collecting sales tax based on the destination sourcing rules beginning in 2025. This would mean that any of our out-of-state retailers that don't have a physical presence in the state are required to collect at local rates based on the shipping address. So this could be upwards of about 10.5% for some of the higher localities like Chicago. There are some companies that are actually challenging this and pushing back on that. One of them is Pet Meds Express, but unfortunately, because it's still kind of working its way through the courts, there hasn't really been any release of what the litigation is going to be surrounding this. So if we could go to the next slide. For Indiana, the most recent update that we're seeing is they are removing the 200 transaction threshold from the economic nexus. Anybody who's heard me speak about economic nexus knows that this is just creating a relationship in the state for sales tax purposes. And once they remove this 200 transaction threshold, this will default to just the 100,000 sales threshold. So once that's met and crossed over, there would be a requirement to collect sales tax. So if we could go to the next slide, please.
All right, the next slide, let's talk about Kansas. And Kansas passed a cleanup bill for some of its income tax provisions. First, Section 163 business interest rules. Kansas does not conform to those rules, and an adjustment is required for interest incurred in a prior year that was deducted for federal in the current year. And the Senate Bill 410 clarifies that. Another clarification is that it adjusted the new tax rate in Kansas adjusted it down from 5.7 to 5.58, another state that is reducing its tax rate. And along with that, the PTET, the pass-through entity tax election laws, needed to be updated to change the rate from 5.7. It was a static 5.7 in the statute, and now the language has changed so that it conforms to the top rate, which is now that 5.58. And another beneficial update for Kansas for the pass-through entity tax is that it previously was not allowed to be passed on to owners, and now it can be.
So Minnesota has enacted a retail delivery fee. We're starting to see this trend in some of the states. Retail delivery fee is a little bit different than sales and use tax. It's an additional tax that is associated with the sales that are going into the state, generally speaking, by some sort of truck. The fee is associated to essentially offset some of the costs of road repairs because of the trucks delivering items into the state.
All right, Nebraska. Nebraska had some changes to the sourcing of non-resident income tax for compensation. And beginning in January of 2025, Nebraska has clarified some of its rules related to non-residents and the convenience of the employer rule. And Nebraska is one of the very few states, like New York, that has what's called the convenience of the employer rule, where non-residents of Nebraska working for a Nebraska-based company may be required to be considered Nebraska employees for state income tax withholding. And the new rules establish a sourcing threshold of 7 days working in the state and $5,000 threshold for activities within the state, as well as other clarifications on the rules for when to withhold for income taxes for non-residents. And next slide. All right, let's go to New Mexico. New Mexico's another general tax bill that passed several new items. The first, it created a new corporate tax rate, a single corporate tax rate of 5.9%. And like many other states, New Mexico expanded a number of tax credits allowed. A number of states have adopted specific credits related to the Federal CHIPS Act, which was the Chips and Science Act in 2023. So New Mexico has a couple of specific credits for that. In addition to the corporate and individual taxes, New Mexico also has a gross receipts tax, and part of this tax bill, House Bill 252, was that a couple of new deductions were added for alternative energy businesses and a deduction for childcare services.
So Ohio has made some changes to the adult use cannabis tax. Some of the things that they released in their most recent update in September really is surrounding the definition of the terms of what adult use cannabis tax covers, as well as the commissioner establishing adult use cannabis tax accounts for each adult use dispensary licensed by the department. There's going to be some changes to the requirement for electronic filing and payment, which is, kind of in par with how the state treats a lot of their other taxes, especially sales tax. And then it's also going to adopt the procedures that sales tax has in place for documentation and support behind this tax. Ohio also has released, Ohio's Common Sense Initiative has released that agencies seeking to amend any type of rule in Ohio must submit an Ohio business income impact tax analysis. The impact tax analysis is a 7-page form that covers a variety of questions relating around the reason for the submission, the regulatory intent, Department of Regulation, adverse impact of to businesses, and regulatory flexibility. It's worth noting that this impact tax analysis does cover a lot of questions of how the changes are going to actually affect small businesses. So if we can go to the next slide, please. So Wisconsin has made some changes to their property tax. They've actually decided to repeal property tax effective January 1st, 2024. That does mean that is the reporting period that it's going to be repealed for. So that would mean any locally assessed tax, state assessed tax on manufacturing personal property, as well as state assessed tax on real personal property are all being repealed. There are some items that will still qualify for property tax, so please note that it doesn't cover everything. There also are some additional exemptions that have been put in place in Wisconsin. One of them being the portable machinery and equipment used for roads and commercial construction, real estate listing service exemptions, and then exemptions for metal bullions. I do want to note on the real estate listings, that's a big distinguishing point that this exemption is still going to be applied for them, because recently Wisconsin had released a digital goods change in their law for taxes purposes for sales tax that is very broad. So the fact that they actually are including this additional industry under the exemption is worth noting, and potentially we could see some additional services be included under that exemption as well in the future. So with that, I think we're going to move to the South next.
Good afternoon, everyone. And we're going to go through the South, starting with Arkansas for the second year in a row. Arkansas has reduced the corporate and personal income tax rates. So now the top rate has been reduced to 3.9% for individuals and 4.3% for corporations.
In Florida, there's been some changes to the sales tax exemption for aircraft, boats, motor vehicles, and mobile homes. Specifically, the sale of boats and aircraft sold in Florida to non-resident purchasers, the rule's been changed. The taxation of motor vehicle purchases by a leasing company that will be rented or leased for 12 months or longer, and the removal of the requirements for invoicing occasional or isolated sales of boat rigs and mobile home appurtenances, which are tax exempt. So more specifically, which I think is relevant because it's a hot topic right now, non-resident purchasers of an aircraft or boat in Florida are required to execute an affidavit affirming that the boat or aircraft qualifies for the exemption and attest that the required documents will be provided timely to the department. In addition, any business established to lease or rent motor vehicles for at least 12 months can pay tax on the purchase of the motor vehicle rather than having to pay it on a subsequent long-term lease or vehicle rental. Next slide, please. Okay, another hot topic about food deliveries. Rideshare company is facing a lawsuit of over $5 million in Florida regarding delivery fees. Basically, this could cost millions due to taxes on delivery fees charged to Florida customers. I know I'm personally feeling it every time I order from Uber Eats, but in Florida, the company has been imposing sales tax on voluntary delivery fees, which is unlawful under Florida's law that customers can avoid the fee by picking up their purchases. The plaintiffs seeking class action status represent over 100 affected customers, with the controversy exceeding $5 million. Allegations include some collected taxes that were not remitted to the state. Cases in federal court and could significantly impact the delivery service industry, emphasizing the need for compliance with state tax regulations.
So Georgia has also lowered its corporate taxes and individual income taxes. So the individual income tax rate in Georgia is going from 5.49 to 5.39%. And this rate will continue. This rate reduction will continue by 0.1% each year until it reaches 4.99%. The corporate rate is going from 5.75% to 5.39%. And is applicable for tax years beginning on or after January 1, 2024. So Oklahoma has amendments reflecting the elimination of the franchise tax beginning with the 2024 tax year. The reporting requirements for 2024 and subsequent tax years. So the rule changes become effective this past August.
Thanks for that great news in Georgia, since I'm based here. Moving on to Oklahoma. Oklahoma's manufacturing exemption for digital asset mining. This was announced and effective November 1st of 2024. So sales of machinery and equipment that are directly used for commercial mining of digital assets now qualify for a manufacturing exemption. The state has given some examples to help taxpayers that qualifying machinery and equipment includes things like servers, computers, power distribution units, cabling, software, and electricity. The exemption for qualifying items began November 1st, 2024, and goes through December 31st, 2029. Next.
So South Carolina, the House Bill 4087 revamps various corporate income tax credits, including the headquarters income tax credit, recycling facility credit, job development credit, and retraining credit. So for tax years beginning on or after January 1, 2023 and prior to 2029, any grant or sub-grant pursuant to the Broadband Equity Access and Deployment Program are excluded from taxable income in South Carolina.
Okay, South Carolina eliminates sales and use tax exemption on durable medical equipment. In this particular case, the South Carolina Supreme Court affirmed the decision of a lower court that denied a seller's place of business limitation that restricted the sales tax exemption for durable medical equipment. This case was really based on some constitutional law in the sense that the exemption that was put in place violated the Commerce Clause, right? Because it made the company not qualify for an exemption because it was not an in-state based company. So what the court did was basically allowed for the refund to the taxpayer and voided the exemption and sent it back to say that, you can reenact the entire exemption, but you need to remove this in-state business requirement because it's unconstitutional.
So in Tennessee, taxpayers affected by Hurricane Helene, they all received tax filing extensions. Long and short is that the majority of states will follow the IRS extended deadlines for disaster zones. Additionally, Tennessee residents who suffered casualty losses to a primary residence may apply for sales tax refunds of up to $2,500 on the purchase of major appliances, furniture, or residential building supplies. Moving on. Additionally, Tennessee this year enacted franchise tax refund opportunities. According to SB 2103, there is a bill that retroactively eliminates the real and tangible personal property measure from the franchise tax calculation. So any taxpayers who paid the franchise tax on the property measure on Schedule G are eligible for refunds. So to obtain a refund, taxpayers are required to file amended franchise and excise tax returns and file a claim for refund of franchise tax paid on property measure form by November 20th, 2024. The department is not automatically issuing refunds, so taxpayers who did pay on the property tax measure are required to apply for the refunds proactively.
Okay, Tennessee Tax Act makes updates to sales and use tax sourcing rules. Effective in July, the Tennessee Works Tax Act implemented new sourcing rules for specific services in relation to sales and use tax. Taxpayers should take note of the updated guidelines on how they're sourcing their Tennessee receipts, both within and outside the state. Some of the key updates were sourcing of sales of services performed on tangible personal property and computer software. The Tennessee Works Tax Act adopted destination sourcing. In addition, leased property, the Tennessee tax Works Tax Act adopted destination sourcing. Licensed computer software and specified digital products are included within this category, provided the primary property location moves out of Tennessee during the lease period. Sourcing for marketplace facilitators. All sales are sourced where the product is received by the purchaser. So destination sourcing. Magazines and book distribution exemptions. Sales into Tennessee of these items are no longer exempt from sales tax. So it's something to take note of because this is a big change as far as the sourcing of certain services. So it's important to review the guidelines. Next. Tennessee also issued updated sales tax news because it clarified the sales tax rates for foods and food ingredients. The notice that was issued states only certain cities and towns are authorized to levy a reduced sales tax on food ingredients, and other goods and services. So it's important to take note of the fact that it's only certain cities and that the reduced tax rate or exemption commences, or did commence, I should say, on October 1st, 2024. Next. Texas introduced an amendment to its homestead exemption. This is great news in the property tax world. The rule concerning the application of property tax exemptions in Texas was amended October 13th, 24, and it allows the appraiser to permit surviving spouses of qualified individuals age 65 or older or disabled to continue claiming the resident homestead exemption without requiring the survivor spouse to file a new application under certain circumstances.
So Texas announced revised franchise tax rates, thresholds, and deduction limitations for the 2024 and 2025 tax years. The tax rate for retail and wholesale remains 3.75%. The tax rate for other than wholesale remains 0.75%. The easy computation total revenue threshold remains $20 million, and the easy computation rate remains 0.331%.
Okay, Texas is a hot state. Texas Controller proposed changes to data processing tax regs. This is definitely a hot topic in the sales tax world, data processing and what constitutes data processing. So the changes made were aimed to clarify and update the definitions of what qualifies as a taxable or non-taxable service of data processing. And the state defined data processing as a service performed with a computer using the customer's data, which includes entering, storing, manipulating, or retrieving a customer's data. Important to read these because data processing, again, is a hot topic in several states, and it's important to know what constitutes data processing and what does not. Next. Texas defined location where orders are received for local sales tax purposes. On effective January 5th, 24, the Texas Controller added to the definition of location of where an order is received for the determination of local sales tax. The amended statute indicates that the location where an order is received for local sales tax purposes. It specifically looks to, the established outlet, office location, or automated order receipt operated by or on behalf of a seller where an order is initially received by or on behalf of that seller, and not where the order may be subsequently accepted, completed, or fulfilled. An order is received when all the information from the purchaser necessary to determine where the order can be accepted has been received by or on behalf of the seller. The location from which a product is shipped should not be used to determine the location where the seller receives the order.
So we're going to run through the West. So Arizona Cardinal ticket fees turned out to be subject to transaction privilege tax, which is another way of saying sales tax, essentially, for that state. It's worth noting that this was a fee that was in agreement with the Arizona Sports and Tourism Authority, which they were required to collect for their use of the State Farm Stadium. They were not charging TPT on the surcharge that was on a per ticket basis, and the state has come back and determined that they actually should have been.
One of the largest developments in the state of California during 2024, as California continues to struggle to balance its budget, was to suspend NOL and credit utilization. In the more than a decade that I have been practicing, this is likely the fourth time, I believe, that California has done this. So NOL utilization for taxpayers with taxable income or AGI over 1 million is suspended from January 1st, 2024 to January 1st of 2027. Likewise, taxpayers with taxable income over 5 million will not be able to utilize certain business credits for the same period, January 1st, 2024 through January 1st, 2027. Along with Senate Bill 167, there is a companion bill, Senate Bill 175. Amongst other things, Senate Bill 175 will make inapplicable the suspension of NOLs and the business tax credit limitation if the California Director of Finance determines that revenues over a multi-year forecast is sufficient without the impact of the NOL suspension. So there is legislation that gives California an out should they not need this. Next slide, please. California also continues to grapple with providing taxpayers enough information to apply their market-based sourcing rules, which are incredibly complicated. There's new proposed rules with regard to 25-136, which primarily deals with intangibles. While we have not received an abundance of guidance with regard to these proposed rules, we do anticipate that businesses such as management, tax, accounting, payroll, legal, business advisory, technology consulting, and investment advisory will be impacted by this proposed rulemaking process. So more to come on the additional guidance that California will provide on 25-136 with regard to sourcing of intangibles.
California has enacted it in September of this year that the extension of the use tax exemption for medical cannabis will be applying to products that are donated by a licensed cannabis retailer to medicinal cannabis patients. And that will run effective through 2030, which could potentially be extended in the future. We'll have to see what happens. So next slide. California has made some changes to their online marketplace collection requirements. So California is one of the first states that has actually imposed an anti-fraud marketplace regulations as well as high seller policies. The updates are extending the requirements for marketplace facilitators to collect certain information from high volume third-party sellers, which includes information on stolen goods, their physical location, their banking information, tax documents, so on and so forth.
States continue to refine their pass-through entity tax, and we did get legislation out of the state of Hawaii this year that further identified who is a qualified member, which is now defined as an individual trust or a state whose distributive shares and guaranteed payments are subject to PTET taxation. Hawaii also lowered the tax rate for the PTET from 11% to 9%. Next slide, please. We continue to see a trend across the U.S. with states switching to a single sales factor apportionment. This obviously still targets states that are doing business remotely in states and allows for some grace to states that are hiring or have personal property or employees within the state. So Montana is the latest to switch to a single sales factor effective January 1st, 2025. Next slide, please. Montana has also followed a trend for states outside of the state of California, I will say, where we are seeing reduced tax rates. So reduced marginal tax rate of 5.9%, and also some other tax matters such as discontinuing the first-time home buyer program.
Nevada is making some changes to their voluntary disclosure program. So the voluntary disclosure program currently right now was only applicable for certain taxes. They have actually expanded how many different new taxes that can actually be included under this voluntary disclosure program. One of the taxes worth noting is modified business tax, which is a quarterly payroll tax that is based on the business paying wages to employees in Nevada. Next slide, please.
In Oregon, we have had a pretty significant taxpayer win with the Microsoft Corp case. Microsoft argued that if they have to include repatriated dividends in their tax base, that they should also get factor representation in the apportionment. In Oregon, the Oregon Department of Revenue did lose this case, with Microsoft prevailing, which is a significant case for the taxpayer, which provides appropriate dilution to the apportionment factor when you have to include something such as repatriated income in the tax base. However, we also have the Santa Fe case out of the state of Oregon, which ruled against the taxpayer. This further eroded what we are seeing as a trend of the erosion of protection under Public Law 86272. As we're all aware, states continue to push the envelope on PL 86272 protections after the Quill case. Even though the Quill case was related specifically to sales tax, we continue to see states leverage that guidance in the income tax arena. So the Supreme Court did rule, or I'm sorry, the courts did rule in this case that the taxpayer did not have Public Law 86272 protection due to their wholesaler activities, and this case has been appealed to the U.S. Supreme Court. Next slide, please. Utah is just yet another state that has given some taxpayers relief with a small reduction to their corporate and individual tax rates from 4.65 to 4.55 as of January 1st, 2024.
Washington has made some changes to the B&O tax. One of the highest ones I would say worth noting is the sourcing for B&O tax. The state has decided that there are a series of questions that can help determine whether the benefit of the service is actually received by a customer's market or whether it's actually at some other customer business location, which could change the way that sales are apportioned in the state. It's worth noting, too, that the B&O tax credit for conversion of employee-owned businesses is also changing, and up to 50% of the costs incurred to convert may actually be applicable. New services are being moved to the retailing classification for B&O tax as well. Historically, there had been only a handful of services that were under there. Now we're seeing a lot more services have been added, such as construction services, landscaping, not that we see very often, but fishing, charting, tattooing, tanning, so on and so forth. If we can go to the next slide, please. Washington has decided to amend the B&O tax clarifications around banks and financial institutions. So effective in January of this year, the department has adopted some changes that do include an additional 1.2% for B&O tax on certain financial institutions. If we can go to the next slide, please. Last but not least, Washington courts have ruled that container repair services are held as taxable. There was a shipping companies, cargoes, containers, and motor generators that were determined to be not exempt from retail sales tax because they are not components of the company's vehicles. So obviously this is just a change that we're seeing in the way that the law is being interpreted for retail sale classifications across the state.
We'd like to thank you all for joining us this morning for this trip across the United States with the state and local tax updates. We'd like to encourage you to subscribe to our Dash of Stalt, which is a weekly update for all state and local legislative changes as they come out. Thank you all so much, and we will see you next time.